The broadcast is now starting. All attendees are in listen-only mode.
Good evening, guys. Thank you for your patience and welcome to tonight's investment update for the Tailored Investment Solutions Rogers International Commodities Index Investment Series 2 update. Before we start, let me go through the disclaimer. The SMSF Club is licensed by RM Capital. RM Capital is the Australian Financial Services licensee. As an individual, myself, Justin Beaton, is authorised through RM Capital to provide advice. Now, tonight's presentation is only general advice. What that means is I haven't considered your individual circumstances when putting together this update. We'll go through some scenarios, and I'll go through what are actual results for the investment and where we're at right now, and any indicative estimates that I'm giving I'll outline at that time. Look, the presentation must not be regarded as advice or any form of recommendation. This is merely an update. Look, as the SMSF Club, our role is to be provide education. Education, so you as a self-managed super fund trustee can make informed decisions. Now that comes to investing, like we're talking about tonight, or informed in decisions when just meeting all of the accounting, administration, and compliance obligations. And that's what we do as a business. However, look, we've sort of evolved as a business, and we've recognised that not everyone has the time or the skill set to make informed investment decisions. So a lot of our clients have now decided to outsource that to us, where we provide not just general advice, but what's called personal financial advice. That's where we sit down, go through a needs analysis, work out your risk profile and your investment objectives, and then you provide you with specific advice as to how you should invest your SMSF money. So if you're interested in more personal advice rather than just education where you make the informed investment decisions, then please email myself or speak to your specific SMSF Club advisor. Look, exciting news. Some of you may have played my board game. We did a tour around the country where we played my board game at our mentoring events mid last year. Following the feedback, we modified the game. Actually, we're launching the game to the actual market. So I'm pretty excited about this. This is a huge achievement, a goal that I've been working on for quite a long period of time as a hobby, probably the last decade on and off. So we do have the game. We have 1,000 copies sitting here that have landed on shore. So look, it's just great timing for Christmas. If you'd love to increase your level of investment knowledge, then by all means buy them a board game. Give it to your children, because one thing that they need, or one thing they have more of than what you do, is time. And as many of you are finding out, some of you the hard way, is that the eighth wonder of the world, as Albert Einstein said, is compound interest. So the idea of the game, if you haven't played it, is to teach people, if you take a long-term view, what can actually be achieved by baby steps, the benefit of compound interest. It's like playing around the board of life, and you get pay rises, you get divorces, you get kids, your income goes up and down, and then you're able to make investment decisions with your savings. You do that for a period of 40 years, from the age of 20 to the age of 60, and whoever has the most money at retirement at the age of 60 wins. So it's a great game. Look, it can be played in 40 minutes or 2 hours. It can be played with two people what I'm hoping to achieve is actually break the Guinness Book of Records for the most amount of people playing a board game simultaneously. That's 2,500 people. So, look, mid to next year, mid to late next year, I'm expecting to have some schools come together to hopefully have a go at breaking that record by playing the game. But look, for clients, you can get access to it. $79 plus postage. Pre-order now. Send an email to admin@thesmsfclub.com.au. It's a great gift for family members, for friends. All proceeds and profits are actually going back to produce more board games to donate to schools. I'd love the game to be in every high school in Australia, and that's the goal of creating the game. It's to create, I suppose, those things that you wish you were taught at school about money, but were never taught. We're taught algebra, we're taught chemistry, and I don't know too many people that apply those skill sets to their life post high school. But something that every Australian has to deal with is superannuation. It has to do with dealing with investing. It's got to do with going to work. And unfortunately, there's no time at school, or very little time at school, that's devoted to those core life principles. The game tries to fill that gap in a fun, enjoyable, and easy way to play. So help me out, help me achieve my goal. Buy the game, and we'll put games in every high school in Australia as a fun learning tool. So that's a game. Now, tonight's webinar, we're going to go through the 2018 Self-Made Super Fund statistics and some performance reports that have just been released to the market by the ATO. The Jim Rogers Series 2 investment update, commodities as an asset class, how I believe that they're the only true form of diversification that we can obtain in portfolio construction. It's gold and other commodities is the only uncorrelated asset class that exists today. We'll go through more of that in detail later. SMSF portfolio theory I'll touch on too, and now we're going into the maturity of that Jim Rogers investment, where to now. Not just from the Jim Rogers investment, but maybe where to now with the current economic and global investment mandate or climate, what things then we need to look out for, and how we can adjust our self-managed super fund portfolio, not just to mitigate the risk on the downside, but also to potentially profit from the market over the next few years. So key statistics. One of the biggest statistics that's just been released is that over the last 10 years, self-managed super funds have outperformed APRA-regulated funds. So the last 10 years, we've had an interesting environment to invest in. Growth assets, certainly internationally, have gone up significantly. The Australian share market has lagged considerably behind that of global equity markets. But I suppose governing and overarching all of those asset classes' performance is that the last 10 years we've had record low interest rates. It's because of that record low interest rates, the actual return from both APRA-regulated funds and self-managed super funds hasn't been that attractive. However, while both of them have been quite low when compared to historical performance, self-managed super funds still have outperformed APRA-regulated APRA-regulated funds. So the return on assets, self-managed super funds 5.59% versus 4.98%. And the rate of return for APRA-regulated funds is 5.58%, where self-managed super funds has 6.71%. So again, this highlights that self-managed super fund trustees are actually doing a pretty good job as a group with managing their investment money. In fact, they're doing a better job than the so-called professionals. Other statistics are the average number of members in a self-managed super fund stays at 1.9. What's interesting in statistics here is the government has I think even passed increasing the maximum number of trustees for a self-managed super fund and members from 4 to 6. Now, I don't think that's going to make a big difference. In fact, what I've found is that the clients of ours, a small number that have more than 2 members, whether it's 3 or 4, it's actually quite hard for them to collectively manage the self-managed super fund obligations. So going to 5 and 6, I don't think that's going to create any real potential benefit. But it's not just here at the SMSF Club on my view on that, but while the average is 1.9, 70% of self-managed super funds have 2 members, and that's generally a husband and wife, right? A family self-managed super fund. They're being branded. Only 3.6% of all self-managed super funds have 3 members. Only 3.9% have 4. The majority, 70.9, have 2 members, and 21% has 1 member. And I think that trend is going to continue, even though there's a capacity to have 5 and 6 members. I don't think it's going to be taken up by too many individuals. The average member balance in a 2-member fund is the first member is 857,000, and the second member 473,000. The average self-managed super fund size is now over $1 million. Self-managed super fund members by gender, 52% are male, excuse me, 48% are female. When we look at the member balance by gender, men is still 22% higher than female, which is unfortunate that the male population has more in superannuation than females. I think the government's trying to implement, and have been doing so for a decade, trying to bridge the gender gap there with superannuation assets by allowing spouse contributions, increasing the low income government co-contribution scheme to encourage small income earners to put more money into superannuation. So I think the true difference is that women generally have time out of the workforce to raise a family or to help their elderly parents. That is the reality of the situation. However, the unfortunate thing is that there's still a huge gap with gender wages. So men still earn more than women. And while there's been huge progress in gender equality in the workforce, I think there's still huge steps that we can take to improve that moving forward. Asset allocation. The largest superannuation or self-managed super fund asset allocation is in listed shares. Direct shares is 28.1% of members have listed shares. Of the cash allocation, of the total amount in the self-managed super fund pool, 20% still sits in cash. And that's the most unproductive place to have money. In cash or term deposits with interest rates at 50-year lows is not going to ensure you meet your retirement savings. So look, if you take anything from this webinar, as I always encourage you all to do, is have a look at how much money you do have in your bank account. It does grow with your contributions. It grows with income earned in the fund, whether that's from dividends or rent or investments and coupons from the Tailored Investment Solutions products. So you probably got more in your superannuation bank account than you probably think. If you do, you've got to look at that money and think about, well, where else can we move that money to earn a greater rate of return. The money in your bank account now, for some of you as clients, Macquarie Bank have reduced their interest rate to 0 if you've got a balance less than $5,000. If it's above $5,000, I think it's around 1.2% right now. Inflation is sitting still above 2%. So when you look at money in cash, that's the riskiest place it can be because your buying power is going down. If we go down the list, non-residential real property, that's direct property, that still sits at almost 10%, 9.7%. In fact, if you look at property, business real property is the major allocation for property in self-managed super funds. That is like commercial property. That's a lot of property that people operate their own business out of. Residential property is only 6.2%, which is relatively low in comparison to what I believe is the perception, not just of individuals, but ASIC and the ATO. Because there's a huge focus on self-managed super funds and residential investment properties where it's sort of frowned upon. We've seen what Shorten come out on behalf of the Labor Party and said that they'll ban any forms of lending in a self-managed super fund, and that's sort of targeting borrowing, where people are borrowing to buy direct residential investment properties. In fact, it's not just residential property that sits at 6%, but even lower than that is only 3.5% of an allocation for self-managed super funds that involves any form of borrowing arrangement. So despite the negative press that we read about borrowing inside of superannuation, there's still less than 3.5% of the total self-managed super fund pool that have a loan. If we look at what everyone else is investing, 100%, like every self-managed super fund has got a bank account, so we'd expect it to be 100%. 65% of self-managed super funds have got shares, direct shares here in Australia. 31% is managed funds, 30% is direct property, as I mentioned. That's predominantly business, real property. Debt securities, income securities, ETFs, 20%, which I believe is probably going to be the biggest growth in self-managed super funds for the next 5 to 10 years, like it has been over the last few years. Direct international shares, 6%, collectibles less than 1%. So that's the latest statistics for 2018. I think what you can take from that is, well, have a look at your portfolio allocation. Are you deviating from the self-managed super fund masses, or are you doing something similar? Are you investing in similar asset classes to the overall market? Is there anything that you can do to allocate capital to more productive assets? So is there an opportunity for you to move money out of cash and term deposits where the rate of return is less than inflation, to move to other investments that offer a higher rate of return to give you a chance of reaching your retirement goals? That's really the questions I think we can take from the latest SMSF statistics. So let's get to the investment. Total Investment Solutions, Rogers International Commodities Index Series 2 investment units. The investment start date, if you remember when we invested, was back in December 2015. So just under, or approximately, almost 3 years. And we're coming up to the maturity of that investment, which is the first week of December. Let's have a look at the investment. The Rogers International Commodities Index is managed by a gentleman by the name of Jim Rogers. Just to recap, I know we spoke about this when you invested. No doubt you did a lot of research into the underlying investment before you invested in the investment. There's a photo of Jim Rogers there now. And when it comes to commodities, he's sort of the go-to guy for a lot of people around the world. The reason he's the go-to guy is that he has a lot of previous success in the commodities space. Jim co-founded the Quantum Fund back in the 1960s. Now, the Quantum Fund is one of the most successful and first hedge funds that's been created in the world. And back then, even now, they have a large expertise in commodities. Jim retired in the early 80s after achieving phenomenal returns and amassing a huge amount of wealth himself. And George Soros has continued to run the fund to go on to be a multi-billionaire now and one of the most drawn-on experts in investment world. The Quantum Fund gained 4,200% in its first 10 years. So the returns that George and Jim achieved in the first decade was phenomenal. 4,200% is outstanding, but it's even better when the S&P 500, the global or the US major share index, only gained 47% over that same period. After record profits 20 years, as I said, Jim retired and he traveled the world. He traveled the world. He wrote a few books called The Investment Biker. He's got a few Guinness Book of Records for the most amount of countries traveled to on the one motorbike. He then converted a convertible Mercedes into a little four-wheel drive, and he did the same tour a few years after the motorbike trip with his Mercedes with his wife at that time. When he was traveling around the world, he recognized that there was a huge shift in economic powers. He saw in just that short period from when he went as an individual to when he went with his wife in traveling to some of the third world countries like China and India in the world, he recognized that there was a huge shift in the economic powerhouses. He could see the shift from poverty to middle class for a large portion of the Chinese and Indian population. He saw that their habits had been changing to become more and more westernized over time. When he went to China initially, he ate a lot of rice. Then when he went back the second time, the food was becoming more and more westernized, and there was more and more of it. He saw more people were driving cars and consuming energy. There was more people looking at investing in precious metals and commodities. So after looking at that and seeing that the powerhouse of the United States was going to lose in the next few decades its dominance as the huge population in China or India take over that of the US economy, he recognized that the easiest way to gain exposure to that migration, the easiest way to make money and profit from it, and the biggest beneficiary with the least risk was through commodities. So he created the Rogers International Commodities Index. At that time, when he was looking at investing, there was no readily available index that covered the three core commodities that he wanted to invest in. Those sub-indexes were agriculture, being food. As the Chinese consumption grew, he anticipated that global food prices would increase over a few decades. He anticipated the demand for precious metals was going to increase, but again, there was no readily available index to invest in to give him exposure to the core key precious metals being gold and silver. The other part was as people were driving more, they were consuming more energy, whether it be fuel or electricity. And again, there was no readily available index to gain upside from oil and natural gas. So he created the Rogers International Commodities Index back in 1998. Since inception, the index has been the best performing commodity index in the world. He's a regular guest presenter on multiple news channels around the world. If anyone's talking about commodities, especially gold, Jim Rogers is the go-to guy. His estimated net worth right now is $1.2 billion. He's written a few books: A Bull in China, Hot Commodities, and Investment Biker. There he is on his bike that he went around the world. That's 3 books. He's written plenty more than that. There he is on news. You may have recognized him. The bow tie is sort of his key core point of difference. So the Rogers International Commodities Index, as I said, is a composite index that it's made up of 37 different physical commodities. Now, those 3 areas that those 37 commodities come from is energy. Energy is like oil, crude, also natural gas. Agriculture is like food, like cattle, pig's ears, cocoa, milk, soybeans, that sort of stuff. And precious metals is mainly gold and silver. That was his core part of it. Now, the RICI, or the Rogers International Commodities Index, is made up of 40% energy, being oil and gas, 30% precious metals, and 30% agriculture, being food, soft commodities. So let's look at the performance. Now, if we remember, gold and silver had a huge rally on the back of the global financial crisis. When the global financial crisis, we saw people move from growth assets as the global markets fell off the cliff and the markets across the globe halved, and people shifted from growth assets to more defensive safe havens, and that has historically been gold. So we saw that happen. So if we look at this chart, 2013, from 4 or 5 years following the GFC, gold and other commodities increased in value. Then what we've seen, if we look at the period from 2013 to 2015, is that commodities went out of favor. The commodity market collapsed. The commodity market collapsed on the back of gold to a degree. The gold price fell back as people moved from gold to more as they gained more comfort in the share market. They gained more comfort in the US share market in particular. So a lot of people shifted money from gold and silver and moved it into growth assets, being shares. As a result, the gold price fell. Another reason that the Rogers International Commodities Index fell from 2,800 to 1,400, so it halved, from 2014 to 2015 was on the back of the oil slump. The oil price went from $100 a barrel or more, $120 a barrel, down to $30. Agriculture didn't really do much during that period. So December 2015 was the investment launch date. We invested in the index at the initial strike value of 1,470. The currency at the time, the US dollar to AUD, was 72 cents. Now, a lot of people at that time said, look, you know what, commodities is terrible. Have a look at the past performance. This thing is halved in value. I'm not touching it. Oil's going to go broke. Gold's going nowhere. And they didn't invest. But look, the important thing about investing is to act against the herd. I'm a contrarian investor, and generally I like to buy things cheap. Like Warren Buffett says, you buy when there's blood on the street. With commodities at that time, there was a lot of blood on the street. And we almost timed it to perfection. We're very close to the low at 1470, which is great. And congratulations for you as an individual. Many people had the opportunity to invest, and a lot of people didn't because they were too fearful to do so. Where we're at now, the RICI value has increased to 1785. The currency's improved slightly in our favour. So over the last 3 years, close enough, the investment index is up 23.6%. So the Rogers International Commodities Index has gone up from 1470 to 1785 over the last, or close enough to 3 years. As I said, the maturity date is in December, 7th of December. So let's look at those three sub-indexes just so we gain an understanding of what's caused the market to go up. And more recently, if you look at it, sort of traded sideways for the last 12 months, and it's down a bit in the last few weeks. So this is precious metals. The reason we invested in this investment was to give us a hedge against everything else. Just in case the Trump effect and global markets was going to collapse, all the uncertainty that exists in markets back 3 years ago, we wanted to have a small part of our portfolio that would increase in value if everything else went pear-shaped. So we're using it as essentially a hedge against everything else. So if the Berkshire Hathaway investment, direct shares or property didn't go up in value, or in fact they fell like they did in the GFC, commodities would go up in value. So it was to have a small portion of our investment exposed to this investment on the basis that commodities aren't correlated to those other growth assets that you might have in your SMSF portfolio. However, over the last 3 years, precious metals, predominantly gold and silver, they generally track each other, have done very little. Initially, it was up by a small amount, 10%. It's given back that over the last 12 months. And more recently, as the global markets, especially in October this year, have been uncertain, we've seen the gold price increase in value. But despite that small increase in the gold price in October, actually commodities as a precious metals component have done very little over the last 3 years. The next one is the agricultural index, so food. Now, while Jim Rogers has the view that food over the next 20 years is going to increase in value as demand outstrips supply, that's over the next 10 to 20 years. And what we've seen over the last 3 years is food prices hasn't changed much. In fact, you look at the index, the agricultural index, and the soft commodities that make up that agricultural index, food has actually declined in value over the last 3 years, so it's down. The only subsector that has gone up is the energy index, and as I said before, that's on the back of oil. Oil has gone from $30 a barrel when we initially invested, so the timing was almost perfect, to $60 a barrel more recently. So we've seen the oil price go from $30 to 70, and now it's sitting, I think it's at 62. So we've had a bit of pullback since October on the back of that. So there are three subsectors. So look, let's recap on why we invest in the first place. And I've touched on this previously. If we look at modern investment theory and the goal to make more consistent returns to reduce risk on the downside, we follow a theory similar to my board game that was created back in 1952 by a gentleman by the name of Harry Markowitz. He came up with modern investment theory, and a core part of that was diversification. Now, the the role of diversification and why diversification works, to give you a bit of history as to how it works, is back in 1952, most asset classes were uncorrelated. What I mean by uncorrelated, and I've used this word a few times this evening, is that generally when the share market went down in value, as an example here in Australia, back in the 50s, maybe the 60s, 70s, 80s, 90s, and early 2000s as well. If you look throughout history over that period, is that especially earlier on in those days, in periods where the Australian share market fell, often property went up in value. If we want to expand the theory of diversification a little bit further, because there was times during that period where both the Australian share market and Australian property market would have fallen, and that was not to do with those key asset classes, but more importantly, the overall economy. So if there was an issue in the Australian economy, then that could have caused both Australian property and Australian shares to decline in value. So if you had your SMSF invested across those two asset classes, you would lose money, even following the theory of diversification back in the 50s. So Harry Markowitz goes, well, don't just invest in one economy, invest across multiple economies, further diversify. So if we look through our period, if you expand and bought United States shares, term deposits in Australia and United States and Europe, and you spread it across different economies, many economies back then worked in different economic cycles. So by not having all your eggs in one basket, you're spreading risk across multiple baskets. You're not going to lose a lot of money when one of those asset classes fall in value, provided those asset classes are uncorrelated. So if we're going to implement the Harry Markowitz theory of diversification, I strongly recommend that you do. You would have a mixture of term deposits, property, international shares, and Australian shares. The problem we find, though, and as I said, Harry Markowitz was 1952. I think everything has moved forward in life except for this modern investment theory. It's still the core investment theory taught at university. The problem that we find today is that the world has become quite small. We are one economy. Like right now, we have people that have tuned in from all areas in Australia. We've got clients online here tonight listening to this webinar from Canberra, South Australia, Perth, Tasmania, New South Wales, Victoria, and Queensland. In fact, we do have investors in this investment from the Northern Territory as well. I haven't checked if they've registered, if they've tuned in. So I reckon when you look at technology, the world has changed a fair amount. It's not just in Australia like it is for my business, but you would know that you're buying a lot of products that aren't just produced up the road at the local manufacturing plant. That might have been the case back in 1952. But you're buying products that are produced all over the world. We are one economy across the world. Because of that, all world economies are correlated. We saw that in the GFC. Right, the United States property market fell, the United States share market fell even further. Here in Australia, where we didn't have any of the banking or the property issues, we fell further than the United States. Everywhere around the world fell through 2008. In fact, it wasn't just shares or growth assets like shares and property that fell in value, but fixed income and term deposits fell a lot as well. Now, the problem is that underpinning all these assets, whether it's fixed income, those that issue bonds and governments, the companies that issue bonds, underpinning all those companies and countries, underpinning everyone or the majority of people for property, underpinning a lot of people that are investing in shares, whether it's Australia or international shares, are using debt to fund it. So if there is a debt issue, all these asset classes that are meant to be uncorrelated, in fact, fall in value. And we saw that in the GFC. So if we look at modern investment theory, it doesn't work when we look at those four core asset classes. So why did we invest in the first place? We wanted to have a portion of our portfolio, irrespective of your weighting across those other four core asset classes, in gold and other precious metals and other commodities like energy that are uncorrelated, in the attempt to increase our returns to make money if everything else fell in value. Now, the Australian share market hasn't fallen in value the last 3 years. It's gone very, very flat, unfortunately. Property market has been up and down, as you know. International shares have gone up, and many of you have made gains in international shares by having exposure to our Berkshire investment. So while we invest in the first place as a hedge against everything else, good news is that look, we haven't made much money when we consider all the costs, but you haven't lost any money from this investment. But it has provided us over the 3 years the benefit of providing that portfolio a hedge against other growth assets. So it's critical that we keep a component exposed to gold moving forward. Now, I'll talk more about gold as to why we want gold as opposed to the other food and oil in a moment. So this is why we did it. Look, if we look at gold as a hedge, if we go back to the oil crisis in the 70s, 1973 to May 1974, the oil crisis, gold increased by 73.9%. 12 months in 87 crash, gold increased by 28%. In the GFC, for 12 months, gold increased by 20%, 19.8. If we look at a 3-year performance of gold from the peak of the GFC to 3 years after it, you see there the red line, which is the Dow Jones, the S&P 500 index, the measure of the US economy. The GFC, the market fell. We saw the gold price rally during that period. Gold price over 3 years increased 127%. So this highlights that gold is uncorrelated to all other asset classes, especially in the event of a debt issue, especially in the event of a major crisis that we experienced in the GFC. That's why we invested, is in the event that if everything else went pear-shaped and fell in value, then the underlying investment would have increased by hopefully a huge amount. The fortunate thing is, hey, the rest of your portfolio hasn't declined in value. So it's worked in essence to provide us a hedge in case our worst fears came true. So over the last 3 years, those worst fears haven't come true. So we haven't experienced huge increases in the index, but we are making a small profit. So while the investment is up 23.6%, let's look at our investment. If you remember, over the first 12 months, the investment was up around 10%. Because of the currency, the first coupon was slightly less than that. You were paid 8.68%. Second coupon, 12 months later, you were paid 4.89% of the total value. If you remember, if you invested 100 grand, your outlay was 20,850, I think it was. So you outlay close enough, let's call it 21 grand. The first coupon that you would have received was $8,680 if it was 100,000 that was your investment amount, your leveraged amount. The second coupon would have been 4,890. So where we're at now, if the index finishes on the 7th of December, as to where we are today, we're up 23.6%. Actually, that was a few weeks ago where we had the first observation date. You would be paid a final coupon of 10.1%. That's that amount. So over the investment period, you would have got 8,680 after 12 months. The second coupon, you would get you were paid 4,890 for 100,000 investment. And the third coupon, if the index is up at 23.6%, as at the 7th of December, would be $10,100. So if we look at your outlay was 20,850, first coupon 8,680, second coupon 4,890. Those two are the actual numbers as to what you would have been paid for 100,000 units. The estimated final coupon 10,107. As I said, it's indicative only, and it'll be determined not just by the RICI value, but also the currency on the final averaging date and the maturity on the 7th of December. So if it is at that level, your total return for coupons is 23,677. So your initial outlay was 20,850. Your total return that you'll get back is $23,677, which provides you a return on investment of 13.56% over the 3-year period. Not huge, it's not outstanding, it's better than cash. But as I said, the investment wasn't meant to perform if the likes of our Berkshire and other global growth assets have increased in value. It wasn't meant to go up during that period. It was merely to provide a hedge in case everything has gone down. The fact that we're walking away with making a return above that of cash, hopefully, is a good outcome. So where to from here? If we look at where we are for global markets, October has certainly created a fair amount of fear. If we go back 3 years ago, we were 7 years into a bull market in the United States. 3 years later, the United States global growth hasn't slowed down. It's gone on from strength to strength. We're now 10 years into the bull market. And no doubt we're closer to the next bust, the next crash than we were 3 years ago. So if we look at where we're at now, well, global growth uncertainty, look, it was a very frightful October. The latest figures is that global markets, like if we looked at the world index, fell on average 7.2%. A lot of global equity benchmark indexes have actually fallen by more than 20% in October. The Australian share market has fallen close to 10% as a result. So it's not just globally, but here in Australia, as we're fearful as to what's going on across the globe. I think that uncertainty has come from, well, China. Just in October, the Chinese economy came out with statistics with the slowest growth rate for economic growth since 2009. Beijing have been trying to slow down their very fast-growing economy to ensure a more stable and prolonged growth rather than volatile growth. But despite that, it was at 6.5% for the third quarter. So while it was the lowest in since 2009, almost in the last decade, it's still pretty robust. What else we got? We've got US earnings volatility. Look, I think that's a perception rather than reality. Unlike the rest of the world, the US economy still looks pretty good, still looks in good shape. But look, I think investors are starting to fret on the fact that corporate earnings growth probably this year is as good as it'll get. We've got higher wage costs, interest rates going up as the Federal Reserve increases interest rates, and we anticipate that they're going to lift interest rates again in December. So the fear is that the markets and maybe economic growth has hit its peak. Despite that, personally, I think corporate profits are still pretty good and expected to grow. The fact that the Fed Reserve are considering increasing interest rates in December sort of suggests that their inside knowledge is that things are pretty good. But despite that, there's always the market concern that, hey, we've had a big rally over the last 10 years, and that's true. And no doubt their view is that we're due for a correction in the not too distant future. When and by how much, that's the question, right? Risk of rising inflation. Look, we've seen the Fed Reserve, why they've experienced such tremendous growth over the last 10 years is that look, they've printed a lot of cash. They've dropped interest rates to record lows over the last 10 years. They've cut taxes. So there's no doubt that inflation is going to increase. By again, how much and when is uncertain. But look, people are concerned about the risk of rising inflation and what that's going to mean. Trade tension, the Trump effect. His pro-America, America first policy has meant that some of his trading partners are refusing to do business, or there's a bit of tension there. He's actually been able to get an agreement with Mexico. He's been able to get an agreement with Canada, two of his largest trading partners, but their biggest trading partner, China, they're still having issues with. And I think that trade tension between US and China is going to continue for the short term, and that's going to create uncertainty depending on how long it takes before they can come to a workable agreement. Rising interest rates in the United States, as I said, December, they're looking at increasing interest rates. That's the broad economic consensus. Political dramas, not just Trump. I haven't looked at the latest statistics this evening, but it appears he's maintained power when I looked at it earlier on today in the House of Representatives and the Senate. I think that's going to be robust for global equity markets. But again, the political dramas led by Trump every day creates a fair amount of volatility on the market and a fair amount of uncertainty when we're looking through the windscreen. But hey, the rearview mirror is always clearer than the windscreen. It's not just in the United States. Here over the last 3 years, we've had a number of politicians. If we go back further, I think the last decade, we've had 7 different prime ministers in that period. So it's not just in the United States, but there's political drama here onshore as well. And that causes our markets to go up and down, not just because of the lack of consistent economic policy flowing through, but a lot of our trading partners are a bit uncertain to deal with Australia because the political uncertainty is creating a fair amount of tension. So they generally trade with other trade partners where that political risk doesn't exist. So there's a lot of things to be worried about right now. And look, that's come to a head in October when we've seen headlines of all these things that have hit the paper, not just over the month, but in fact, I've got all that out of one newspaper. Global growth uncertainty, China concerns, US earnings volatility, and that was on the one day. So look, the market, the media is portraying that we live in very uncertain times. So look, moving forward, I think we need to maintain our exposure to a small amount of your portfolio to uncorrelated asset class. We need to ensure that we're protected in the event of any of these issues creating the next global financial crisis. We cannot ignore the fact that over the last 10 years, the US economy has gone on from strength to strength. Every 10 years thereabouts, the market has a correction. And generally when there is a correction, defensive assets like gold go up in value. So we need to maintain portfolio diversification to ensure in the event that one of these things creates the next pullback, you can potentially profit from it. So it's not just an opportunity to hedge, but also to make a profit moving forward. So that component, irrespective if you've got property, Australian shares, international shares, or fixed income, call them growth assets, for 90% of your portfolio, you need to have some form of portfolio weighting towards gold as a defensive asset to protect you on the downside. That's where the theory of diversification comes in today's market, where the rest of them are correlated with the global economy being that of one. As I said before, if we look at how the gold has performed during the crisis of the past, when we've had a correction, where it's 73, the 80s, even the Asian banking crisis in the 90s, the GFC, as you can see, every 10 years thereabouts, there's a big pullback in global markets. Where it's the oil crash, 87 crash, GFC, the Asian banking crisis, or whatever is going to come out in the next few years, decade, the next big crash. What we've seen is when the markets have fallen, gold is a good place to be invested. 73.9% return, the oil crisis, gold went up 28.8% in 87 crash, 19.8% in the GFC, and over a 3-year period, 127% with the GFC period. So gold is not just historically, but acted as a defensive asset because people view it as a safe haven and move money from growth assets to gold because it's more certain. Because of that, we've moved the investment. We're not going to go with Jim Rogers any further. The reason why I'm deviating from Jim Rogers is that we've been lucky over the last 3 years to have exposure to a diversified commodities index by way of oil. Oil has had a huge rally to go from $30 to almost $70. My sort of fair value for oil is 65, so it's gone up what I think it should have. I can't see it going up much from here, and I think it's going to trade between $60 and $80 for the foreseeable future. That's my personal view. So having a large 40% exposure as the Rogers International Commodities Index to oil and other energy, I think isn't productive. It's worked for the last 3 years, which is great. It's provided us a return, but now it's more to go to 100% focused investment exposed to gold. The other part with food, as I said before, soft commodities. I do believe in Jim Rogers' theory that over the next 20 years, there's going to be a higher demand led by India and China markets for food, and that will push food prices up in value. The next 3 years, and why we're looking at putting together this investment, is not to have a view on what food prices is going to do, is to ensure we have a portion of our portfolio that's exposed to a defensive asset. That defensive asset is gold. So we're deviating away from the Rogers International Commodities Index and giving them the opportunity to invest in 100% exposed investment to gold. To reflect on why we've gone with gold, let's go back to Jim Rogers. His comments more recently: if the world economy gets better, commodities are a very good place to be invested. Even if the world economy does not improve, commodities are still a fabulous place to be. And we've seen that over the last 3 years. The world hasn't come to an end. The economy has got better, and we've made money from the commodities index, which is great. Commodities have always gone up when a country is printing money, and every country is printing money now. That is true. Like, that was the case 3 years ago, and it is today, especially in the United States and China. They're printing money to fuel their economic growth. That's not sustainable, and eventually the tide will go out. Who's swimming naked at that time, we'll find out. Investors should take precaution right now to protect their money from a major market disaster that will destroy the economy and impoverish millions of Americans. Look, that's pretty extreme. I'm not too sure about that, but to the extent of the crash. But hey, when right now in the United States, whether it's companies or the country sits on record debt levels, then look, it could be worse than what we've experienced in the past. For the first time in recorded history, we've all major banks and central governments around the world printing huge amounts of money. This has never happened in world history, and so the world is floating on an artificial ocean. It's true. You've got to pay the price someday, whether you like it or not. The longer you delay the day of reckoning, the worse the day of reckoning is going to be. This is not going to be fun. What he's referring to there is when it does actually occur. He anticipates the GFC event to be small in comparison to the next crisis. I'm not too sure. I'm an optimistic guy, but I do know that, hey, we've enjoyed a 10-year rally. We need to be taking steps to protect our portfolio on the downside, even if it's only a 5-10% exposure. By having a leveraged exposure that Tailored Investment Solutions offers, that can provide you not an opportunity to hedge on the rest of your portfolio, but actually profit during those terms. Now, I'm not saying to sell out of everything else and move just 100% into gold. Of course, look, if it does take 5 years before these things to happen, you can lose a lot of money in that time if you shift out of growth assets at these levels. So, not saying to shift and sell everything and shift to gold. It's just to ensure that you have a portion of your portfolio to gold to profit in the event that a GFC event occurs. So why gold? Let's look at gold as an asset class. Gold is unique. There's no doubt about that. The economic forces that determine the price of gold are different from the economic forces that determine the price of many other asset classes, such as shares, bonds, and property. Gold, therefore, has the benefit of diversification in our portfolio. It gives us the benefit of what Harry Markowitz invented, where we need to have a spread of our eggs across multiple baskets to ensure if we drop one, it's not going to affect the rest of them. Gold offers investors an attractive opportunity to diversify portfolios by gaining leveraged exposure to a defensive asset. What we're looking at doing is how we gain exposure to gold is actually through an ETF, an exchange traded fund. Many of you will be familiar with ETFs. As I said before, I think that's going to be the growth in not just self-managed super fund market asset allocation, but in asset allocations around the world. Exchange traded funds are a very low-cost way to gain exposure to different underlying assets. In this case, we're using an exchange traded fund to give us exposure to gold. That is through the SPDR GLD share ETF. The stock code is GLD. It is listed on the United States share market. So it's easily tradable, it's very liquid and transparent. It's originally listed on the New York Stock Exchange in November 2004, so it's been trading for a long period of time. Now it's on the New York Stock Exchange. The MER, the total MER for the investment is 0.4% per annum. So the management fees for GLD as the ETF are very small, which means it's got a very high 99% tracking to the gold spot price. So how we overlay our investment? We overlay the exact same structure that we had with the Jim Rogers investment, but this time we're replacing the RICI index with that of GLD. So it gives us exposure to gold, which is the non-correlated defensive asset that we're searching for. You can borrow the 100% of the investment amount at an interest rate of 4.95% fixed for 3 years through a limited recourse loan. There's a 2% currency hedging fee because GLD is trading in US dollars. You can borrow 100% in your self-managed super fund. It's quantified downside risk in that if you outlay $20,850, that gives you exposure to a $100,000 loan, $100,000 exposure to the gold investment. The maximum you can lose, though, is the 4.95% interest rate per annum plus the 2%. Over the 3 years, that works out to be 20.85% of the total investment amount. Every quarter, you've got the opportunity to sell out. However, look, you shouldn't rely on that. The investment is designed to be held to maturity. There is potential for yearly income distributions, just as there's been for the Jim Rogers investment. If the index is up 10%, you get paid the 10% out. Well, actually, you get 9. I get 1 for a performance fee. That's how I make money from the investment. And that 9% can be a large portion of your initial investment outlay being only 20% of the notional exposure. It's a 3-year term. So the yearly income is year 1, year 2 of any gains up to 10% gets paid out as a distribution, and in year 3, any gains less those coupons paid. So let's look at an investor example. Let's say you want to invest 100,000 units. If you've got 100,000 units in the current Jim Rogers investment, you would be getting around about $10,000 back if we looked at that previous estimated final coupon. You've already been paid 8 and another 4 in the first and second coupon, so the third coupon would be around $10,000. So if you had 100,000 units and you had 10 grand, 11 grand thereabouts, you could take 50,000 units potentially by using just the final coupon that we expect to be paid. If you want to increase it to 100,000 units, if you've got money sitting in cash, you might want to add cash to take it up to the 100,000 units that you've had for the Rogers investment. Investment amount 4.95% plus 2.2%. That's the interest and the hedging fee times 3 years. So 20,850. There is an advisor fee that the SMSF Club charged to cover the cost of putting the investment together of 2,200. So the outlay is $23,050. The risk, look, that $20,850 is at risk. There's no guarantee that the investment is going to pay any coupons. If the gold price, GLD, as the ETF does not go up in value over the 3-year periods, you get a 0 first coupon, 0 second coupon, 0 final coupon. So you would lose $20,850. That is the maximum amount you can lose. There's no chance the 100,000 limited recourse loan can be clawed back. There's no established market for the units. As I said, while there's liquidity every quarter, you should be investing on the basis that you're going to be holding it for a full 3-year period. If you redeem it within a quarter, there could be break fees as we unwind the investment and the loans and all that sort of stuff. Counterparty risk, the issuer, the hedge counterparty is the investment grade bank. The panel like UBS, Citigroup, Merrill Lynch, Bank of America, Credit Suisse, Societe Generale. So there's some of the biggest banks in the world that we're hedging this through. If one of those banks that we hedge it through, if they do go broke, then your $20,850 is at risk. Nothing else is at risk. For a full list of all the risks, you should read the product disclosure statement, which I can email you after the presentation. So let's do the hypothetical scenarios. Let's say the investment goes down year 1, gold goes down year 1, year 2, year 3. There is 0 distribution in year 1, 0 distribution in year 2, 0 value at maturity. So your $23,050, that's $20,850 plus the $2,000 advisor fee. $23,050 is what you would lose if it went down in value year 1, year 2, year 3. Means 100% loss would be your return. If it goes down year 1, goes down year 2, and let's say it's up 40% in year 3, your coupon in year 1 would be 0, the coupon in year 2 would be 0, but the final value would be $36,000 at year 3. So your outlay of $23,050, it would be worth $36,000. So you would make a return of, or a profit of 56%. Let's say it goes up in year 1, up in year 2. So first year coupon, you'd get 9 grand. Second year coupon, you'd get $9,000. That's 18 grand. That's the maximum coupon. Now, currency may fluctuate that up and down, but let's assume the currency stays the same. And then the third year, GLD plummets. So the final value is 0. Over the 3-year period, you'd be paid 18 grand. That would be in your bank account. The 23,050 was your outlay. That'd be worth 18 grand. So you'd make a 22% loss. If it went up year 1, up year 2, up year 3, let's say it was up 60% GLD. Let's assume that the GFC has occurred. Gold has gone up in value. You get 54 grand back from a $23,000 outlay. That'll give you 134% profit. So as we can see there, the return is high, but you've got to be prepared on the downside, that bottom line. So what happens in worst case scenario? Worst case scenario is that you can lose over the 3-year period the $23,000. If you're not comfortable with that, you can look at investing less, like 50,000 units. It's 11 grand. Thereabouts, or something in between. If you are comfortable with 23 grand, then maybe you could consider investing more than 100,000 units. That is up to you. You've got to be comfortable with that, understanding what the downside is. And that's our goal here at the SMSF Club. That's one of my integral parts of what I do my job is I want to explain the downside, plus also the upside potential returns. That way, by only knowing the maximum quantified downside risk, you can make informed investment decision. So if we looked at that as an example, your investor outlay $23,050 as I showed before. Scenario 1, if it went down year 1, down year 2, down year 3, you'd get 0 coupon, 0 final coupon. So would you lose the $23,050? If it was up, down year 1, down year 2, and then end up 40% in the final year, you get paid 36 grand, which is a profit of 12,950. You'd make 56%. Scenario 3 is up year 1, up year 2, and then it plummeted in year 3. You'd get a coupon of 9 grand year 1, 9 grand year 2. That's $18,000, but you'd still lose 5 grand from your $23,000 outlay. So your loss is 22%. Scenario 4, if it was up 60% over the investment period, you'd make a profit of $30,950 or 134% on your 23 grand outlay. So as you can see here, by only having a small percentage of your portfolio to gold, it gives you a leveraged exposure on the upside. So if gold goes up 60%, you make double that. We're making 134%. And that's a benefit of leverage and magnifies the returns on the upside. But you have to be prepared that leverage is a double-edged sword. If it doesn't go up, you can lose your outlay, which is the interest, hedging fee, plus the advisor fee over the 3-year period. So I mentioned before, look, the key part of asset allocation, the key part of running your fund when it comes to your investment strategy is to consider risk management. You have to do that as your obligation as a trustee. If all growth assets are correlated these days, which I think we're becoming more and more so, and in October we experienced that, in the GFC we've experienced that, we do need to have a part of our portfolio exposed to an uncorrelated asset. That is gold. I'm not saying to have a huge component in gold, but a small portion of your portfolio in gold to act as a safe haven in the case of a GFC event. As Jim Rogers said, look, world economies, especially in China and the United States, they've been printing a lot of cash over the last decade to fund that growth. I think they've run out of ammunition, and no doubt 10 years on, we're getting closer and closer to that day of reckoning. When it happens, I'm not too sure. Why it happens, I'm not too sure, and how far it falls, I'm not too sure. But in these times, it's very important to consider risk management, and the only way to do that is either convert 100% to cash, and the problem with converting to cash is if this day of reckoning doesn't happen for 5 years, you're going to miss out on huge returns, and cash is 1%. It's going backwards. So you can't achieve your retirement goals by converting to cash. It's to maintain exposure to those growth assets, whether it's property, shares, Berkshire, fixed income, whatever you've chosen to invest your fund, is to have very little money in cash, but to protect yourself on the downside. My view is we need exposure to the defensive asset. The only defensive asset I know in today's marketplace is that of gold. Investment closes the 15th of December, so we've got a bit of time. We've also got the ability to time it, where we get the cash back from the final value of the Rogers investment. That final value is the 7th of December. Would expect to have funds in your bank account by the 15th, which is when the funds are needed to move into this gold investment. If you've got any questions, please email me or your advisor. If you would like a copy of the product disclosure statement, by all means, put your details in the questions and we can send it out to you. It's an easy way to do it right now, or flick us an email. Talking about questions, I haven't looked at questions. It's sort of been rambling, talking about the specific investments. So I'll go to questions. I think there's been a few questions during the period, which is good. Why is it December 2016? Not too sure. It's meant to be December 2015 when the investment took place. So I'll have to look at that. The commencement date was 2015. So thanks for bringing that to me. Well, yes, the first coupon is the December 2016. The second coupon was December 2017, and maturity is December 2018. So it could have been the first coupon. That was a while ago, so I'm not too sure what slide you're referring to, Vicky. When it says the coupon is capped at 10%, does that mean if it goes up more than that, we aren't paid anything above that each of the first 2 years? Great question. So if the first year, if the investment is up 20%, you get paid a coupon of 10. Now, if the index stays at that same level for the next 12 months, so let's say we're up 20 in year one, you get paid 10. In year two, if it's still up 20% from the initial start value, while it's gone up nothing in year two, you get paid that second 10% in year two. So you get paid. So it's not as if the returns are capped 10% a year, so you miss out on those gains if it rallies by more than 10% in the first year. You don't miss out on them. It just rolls on to when the investment is either redeemed or the next coupon or the final value at maturity. So it's not lost, it's just delayed the payment until a future year. In essence, what it does do, though, is that if the market does fall, by paying a portion, let's say it's up 20%, you cash in 10, it reduces a lot of the risk because you've been paid the capital. We're sort of like harvesting the growth along the way. So why we pay out that coupon, because gold and the other commodities don't pay a dividend or rental income. There's no income. So we artificially create those coupons to as a risk reduction mechanism to take capital off the table over the period. Hopefully that makes sense. But yeah, so the returns aren't capped. It's just what you get paid out is capped for year one and year two. Any of the returns are deferred to wherever it is the following year or at maturity or when you redeem. If gold is insurance investment, why do we use leverage? The leverage component is critical. Let's say you have $100,000 in your self-managed super fund, just using that as a example. If you put $10,000, call it 10 grand, into gold, like by going to buy the physical, and let's say the GFC, you have 90 grand invested in growth assets, call it shares, property, and you have 10 grand invested in gold, the physical, without leverage, okay? In the event of a GFC, let's say that the GFC event happens, shares and property halves in value. So you lose 45 grand on the 90K. It's gone down by half. You lose 45 grand. Let's say gold doubles. If you've only got 10 grand, you're only going to make $10,000 profit. So in fact, by only having 10% to an unleveraged investment in portfolio construction, you're not really effectively protecting your portfolio. Essentially, all that you're doing is reducing the bloodbath. Rather than losing 45 grand, you're losing 35 grand. Hopefully that makes sense. By incorporating a leveraged investment, we have 10 grand. Call it 10 grand. That 10 grand, that same 10 grand that we're looking at, 90 grand stays in your growth assets, being property and shares, similar to scenario one that I just spoke about. If we've got 90 grand in growth assets and the GFC happens, let's assume that it's not protected and we lose 30 grand. Or it halves in value, so we lose 45 grand, same scenario. If we've got 10 grand to the Tailored Investment Solutions gold investment, that actually gives us $50,000 exposure to gold. So if gold doubled, like we're using in scenario one, we don't make 10 grand, we make 50. So if we lose 45 grand on the growth component and we make $50,000 profit on the gold investment, you're now up 5 grand when everything else has gone down 30%. That's why the key to reducing the risk of your overall portfolio is not just to have exposure to gold, but also to have it as leveraged exposure to gold. Provided that leveraged exposure to gold is through a limited recourse loan. That is critical. And it's the only way you can gain a loan through your self-managed super fund anyway. So there is no protection to the investment to save the initial outlay. Great question. No, there isn't. Of course, you're borrowing the investment amount. Interest and the hedging fee is at risk. So the $23,050 over the 3-year period is at risk. That's why you'd only do a small portion of your portfolio to it, because if the gold price doesn't go up, then you're going to be comfortable with the downside risk. If we're looking at 10% allocation, that works out to be around 3.5% a year of your total portfolio that you can lose to give us that leveraged exposure to gold on the upside. If you don't want to take on any risk, then just don't leverage. You don't borrow. Well, you take out the leveraged investment, but you've got to look at an investment that provides you a rate of return of around about 7% a year to offset it. to act as a hedge, like an income security investment that you can look at investing in. That would reduce the risk in that you'd earn income from those investments to offset the interest and the hedging costs, or to go a long way to offset it. What are the benefits of the gold investment with no risk mitigation compared to normal shares with a put option? Well, look, the normal shares with a put option is fine, right? That's a great strategy. And that's where I'd have a portion of my portfolio is in for the 90%, right? 90% is exposed to growth assets, and that is, for me, a protected share portfolio. Buy shares, buy a put option. But in the event of the GFC, the JB wave lost 3%. None of my shares went up. They fell 50. The put option protected it, right? So if we go back to a scenario 3 to a previous question, scenario 1 is if we have 90% exposed to growth assets, 10% to just gold without leverage. If the GFC event happened, that 90% portfolio would halve in value, so it would go down 45 grand. Gold would double, so we make $10,000. We still lose 35 grand. That's scenario 1, right? Scenario 2 is we have 90% of our portfolio exposed to growth assets with no protection, 10% to leveraged tailored investment solution gold investment. That 10%, 10 grand, gives us 50,000 exposure to our portfolio. 90% GFC halves in value, so we lose 45 grand because it's not protected, but we make 50 grand from the gold investment. So overall, we make $5,000. That's scenario 2. Scenario 3. Scenario 3 is the 90 grand is through the JB way, which is protected. So you buy stock, buy put options. In the event of the GFC, my shares that I had at that time halved in value. So look, they lost 45 grand. But because I had the put option, my loss was limited to 3%. Let's call it 5 grand for argument's sake. Let's say it's 6% that we lose in the JB way. So scenario 3 is you've got the 90 grand invested in growth assets, being shares. That 90 grand, the GFC event has happened. Your 90 grand is now worth 85,000. The other 10 grand, you've got in a leveraged tailored investment solutions gold investment. That's given you 50 grand exposure to gold over the 3-year period. That's called gold doubles. So your 10 grand is now worth $50,000. Your 50 grand investment's doubled, so you've made 50 grand profit, right? So while the JB way you haven't made any money, you've lost 5 grand. So your 90 grand's now worth 85. The 10 grand is worth 50. So your portfolio is now worth $135,000. So as I said initially, this investment doesn't just provide a protection on the downside, it also offers the opportunity to create extremely high positive portfolio returns when complemented with the JB way, buy stock, buy put option investment strategy. So that's how I would incorporate it. Where if we're just comparing with no exposure to gold, just the JB way, in the event that GFC happens, you'd lose the 5% or 3% to 5%. So we'd still lose money. By having a small portion to gold, it gives us the capacity to make, well, not just to reduce risk, but also to enhance returns. That's why it's important to incorporate both. If there's a possibility that a crash can be bad, that the put options won't work. No, the only reason the put options won't work is if the Australian Stock Exchange goes broke. It's guaranteed by the Australian Stock Exchange, Australian Clearinghouse, through what's called novation. The GFC happened, and at not one stage did the Australian share market, in fact, any global economy and share market around the globe that I know of, defaulted on a put option. I do not know that. When you're buying an exchange traded put option, it's guaranteed by the Australian Stock Exchange. That's what we do for the JB way. How the ASX hedges its risk is the people that sell you the insurance, they get marked to market. So they have to hold a huge amount of cash or other assets at the ASX to protect the ASX in the event that the crash happens. So it's not really on the ASX's balance sheet. It's marked to market every day, which provides you with a high level of security and certainty. Look, that's taken us just over, an hour and 15. Time's got away from us. Look, Out of all investors, I think we've got about half that have registered for tonight. I think there was less than half that actually attended. So look, I get amazed every day that people don't attend. Like, everyone's outlaid in investment. We've tried to give yearly updates on the investment, obviously coming up to the maturity. All investors need to make a decision as to what to do with his investment moving forward. Yet less than 50% of those investors could be bothered tuning in. That being the case, you did. So look, I respect and applaud each and every one of you for taking time out of your schedule to ensure that you are informed and educated so you can make an informed investment decision as to how to move forward. So congratulations. As an SMSF trustee, I believe it is your obligation. As I said, this presentation was general advice. If you want a personal advice, then speak to your advisor. If you're after the product disclosure statement, then please email me and we'll send one through. In the meantime, what you can do, go out and buy gold. Go out and fill your cars up with petrol, because the next month we need the Rogers International Commodities Index to go up, so we all need a 2-hour bit. Although I think filling up your car is going to have an immaterial effect on the overall oil price in the global scheme of things. So thanks for tuning in. Look forward to helping you. And look, if you want to discuss individually, then email Grace or myself, and we can organise time to catch up, talk about your options. Thanks very much, and good night.